In October 2025, something unprecedented happened in global finance. The BRICS nations, Brazil, Russia, India, China, and South Africa, collectively dumped nearly $29 billion worth of United States Treasury bonds in a single month. $29 billion. Gone. In 30 days. But here is what should terrify you: this is not a one-month blip. This is not market noise. When you zoom out to the full 12-month period from October 2024 to October 2025, the numbers become absolutely staggering. China shed $71.4 billion in American debt. Brazil dumped $61.1 billion. India offloaded $50.7 billion. We are talking about nearly $200 billion in United States Treasuries sold by just 3 countries in 1 year. Now, I am not a doomsday preacher. I am just looking at the data. And the data is screaming at us. The analysts at ING Bank put it perfectly: BRICS nations are quietly exiting the United States Treasury market. Quietly. That word should send chills down your spine, because when major creditor nations start quietly divesting from your debt, it means they see something on the horizon that the general public does not. So why is this happening in late 2025 and early 2026? Why not 5 years ago? Why not 5 years from now? The answer lies in 3 converging forces that have created a perfect storm. First, we have the structural aftermath of the Federal Reserve's most aggressive rate hiking cycle in 4 decades. From March 2022 to July 2023, the Fed raised rates from near zero to over 5%. That destroyed the value of existing bonds held by foreign governments. When you buy a treasury bond yielding 1% and then rates jump to 5%, your bond becomes worth significantly less. Central banks got burned holding low-yield American debt. Second, the geopolitical landscape has fundamentally shifted. The sanctions on Russia after the Ukraine invasion in 2022 showed every nation on earth that dollar-denominated assets can be weaponized. If the United States can freeze Russian central bank reserves worth $300 billion with the stroke of a pen, what is stopping them from doing it to China? To India? To Brazil? This is not hypothetical paranoia, this is rational risk assessment by sovereign wealth managers. Third, and this is the piece most people miss, there is now a credible alternative emerging. For the first time in 70 years, countries have a viable path to reduce dollar dependence. The BRICS nations are actively developing bilateral trade arrangements in local currencies, expanding the cross-border interbank payment system as an alternative to SWIFT, and most importantly, accumulating physical gold at rates we have not seen since the 1970s. The timing is not coincidental. This is structural, strategic, and accelerating. Let me explain the first fundamental problem driving this exodus, and it involves numbers that sound made up but are absolutely real. The United States federal debt currently sits at approximately $35 trillion. $35 trillion. The annual interest payment on that debt has now exceeded $1.1 trillion per year, more than the entire defense budget. Think about that. America is now spending more money servicing its debt than it spends on its entire military. Here is where it gets worse. Between 2020 and 2023, the Federal Reserve printed nearly $5 trillion, 40% of all dollars in existence were created in just 3 years. The M2 money supply exploded from $15.5 trillion to $21 trillion. BRICS central bankers watched this in real time. They watched the purchasing power of their treasury holdings get diluted by 20 to 30% through inflation. Now, JPMorgan, one of the most connected banks to the Federal Reserve, has issued a bearish forecast on the dollar for 2026. Meera Chandan, co-head of global currency strategy at JPMorgan, stated their outlook remains broadly bearish on the dollar. When the largest American bank publicly bets against the American currency, you know something has changed. But here is the insider move that should alarm you. While JPMorgan tells clients the dollar will weaken, look at what their executives are doing. In the third quarter of 2025, multiple major bank CEOs sold significant equity positions. Jamie Dimon of JPMorgan exercised stock options worth over $140 million, his first sale in 17 years. When bank executives who have held through every crisis suddenly cash out, they are reading signals the public is not privy to. The BRICS nations see this too. They understand that the Federal Reserve faces an impossible choice: either keep rates high and trigger a recession that destroys tax revenues and makes the debt unsustainable, or cut rates and restart inflation that devalues dollar assets. Either path leads to dollar depreciation. So they are exiting now, before the rush for the exits begins. The reflationary trap is simple: America has too much debt to sustain high rates, but too much inflation risk to return to zero rates. The BRICS nations are not waiting around to find out which poison the Fed chooses. They are diversifying now. Now let me show you what is happening behind the curtain while everyone focuses on Treasury sales. This is the part of the story that reveals the true strategic shift underway. Global central banks purchased over 1,000 metric tons of gold in 2024, the second highest annual purchase on record. Who is buying? Overwhelmingly, it is emerging market central banks, with BRICS nations leading the charge. China officially added 225 tons to its reserves in the past 18 months, though most analysts believe the true number is much higher given China's history of underreporting gold purchases. Why does this matter? Because gold is the anti-dollar. It cannot be printed, sanctioned, or frozen by any government. When central banks shift from paper dollars to physical gold, they are making a statement about trust, or the lack thereof. But gold is just one piece. The bigger story is the development of alternative payment systems. The BRICS nations are building bilateral currency swap arrangements that bypass the dollar entirely. When Brazil trades with China, they now settle in Brazilian reals or Chinese yuan, no dollars involved. India and Russia have developed a rupee-ruble mechanism for trade. The volume is still relatively small, but it is growing at approximately 40% year over year. Here is where the timeline becomes critical. At the BRICS summit in August 2025 in Kazan, Russia, the bloc announced plans for a new payment system to facilitate trade in local currencies. They stopped short of announcing a unified BRICS currency, but the infrastructure being built serves the same purpose: reducing dependence on dollar-denominated transactions. The European Central Bank and Bank of Japan are also playing into this. Their monetary policies are diverging from the Federal Reserve. The ECB is maintaining a more hawkish stance on inflation than expected, keeping rates elevated even as the Fed signals cuts. This creates interest rate differentials that pressure the dollar. Meera Chandan from JPMorgan specifically cited this policy divergence as a key factor in their bearish dollar call for 2026. Think about the compounding effect. BRICS nations sell treasuries, buy gold, develop alternative payment systems, and coordinate with each other on reserve diversification strategy. Each piece amplifies the others. This is not random market activity, this is coordinated de-dollarization. Now, are BRICS nations completely abandoning the dollar? No. That would be financially suicidal given the current structure of global trade. But they are reducing exposure from perhaps 70% dollar reserves to 50 or 40%. That rebalancing, when you are talking about multi-trillion-dollar reserve pools, creates enormous selling pressure on United States Treasuries. This is where things get truly dangerous, and where most analysts either do not understand the mechanics or are too afraid to say it publicly. The Treasury market is not just about bonds, it is the collateral foundation for roughly $600 trillion in derivatives globally. Let me explain how this works and why it matters. When major financial institutions engage in derivative transactions, interest rate swaps, currency futures, credit default swaps, they post collateral to back those positions. The most common, most liquid, most trusted collateral is United States Treasury bonds. Treasuries are treated as cash equivalents in derivative markets. Now imagine what happens when BRICS nations dump $200 billion in treasuries annually. Bond prices fall, yields rise, and suddenly the value of collateral backing derivative positions declines. When collateral values drop, margin calls get triggered. Institutions must either post additional collateral or close positions. Closing positions means selling more treasuries, which drives prices down further, triggering more margin calls. This is a classic death spiral. We saw a preview of this in March 2023 with Silicon Valley Bank. The bank held large treasury positions that lost value when rates rose. When depositors panicked and withdrew funds, SVB had to sell those treasuries at a loss to raise cash. The sales accelerated the price decline, triggering more withdrawals, forcing more sales. The bank collapsed in 48 hours, the second largest bank failure in United States history. But here is what they did not tell you: the Federal Reserve and FDIC activated emergency lending facilities providing approximately $300 billion in backstop funding to prevent contagion to other regional banks. That program, the Bank Term Funding Program, was supposed to be temporary. It is still active as of January 2026 because the underlying problem never got fixed. Regional banks are still sitting on approximately $600 billion in unrealized losses on their bond portfolios. Now scale that up to the entire treasury market. If BRICS selling pressure causes treasury yields to spike, say the 10-year goes from 4% to 5% or 6%, the mark-to-market losses across the global financial system would be catastrophic. Insurance companies, pension funds, sovereign wealth funds, money market funds, all of them hold massive treasury positions that would get crushed. The derivatives exposure amplifies everything. A pension fund might hold $50 billion in treasuries, but have $200 billion in derivative exposure using those treasuries as collateral. If the collateral value drops 20%, they do not just lose $10 billion on their bonds, they face margin calls on the entire derivative book. This is how you get institution-threatening losses from seemingly modest moves in underlying markets. Here is the insider signal you need to watch: look at derivative notional values at major banks. According to the Office of the Comptroller of the Currency, the top 4 United States banks hold over $170 trillion in derivative notional exposure. JPMorgan alone accounts for over $50 trillion. These positions are hedged, but hedges only work if counterparties survive. If a major institution fails and cannot meet its obligations, the hedges break down and losses cascade through the system. The Federal Reserve knows this. That is why they have been conducting stress tests specifically focused on interest rate risk and bond portfolio losses. That is why the FDIC has been quietly urging banks to extend asset duration and improve liquidity buffers. These are not normal times, and regulators are preparing for scenarios they will not discuss publicly. The BRICS Treasury sales are pulling on a thread connected to a $600 trillion derivatives tapestry. Nobody knows exactly where the breaking point is, but we are moving toward it with each passing month. So how do you know when this situation is moving from concerning to critical? Let me give you specific indicators to monitor, because by the time this hits mainstream news, it will be too late to protect yourself. First, watch the Treasury yield curve. Specifically, watch for sudden spikes in yields that cannot be explained by Federal Reserve policy. If the 10-year Treasury yield jumps 50 basis points in a week without the Fed raising rates, that is forced selling by foreign holders. We saw mini versions of this in October 2025 when yields spiked following the BRICS sales data release. Second, monitor the MOVE index, that is the Bond Market Volatility Index, equivalent to the VIX for stocks. Normal readings are between 50 and 80. During stress, it spikes above 120. In March 2023 during the banking crisis, it hit 190. If you see the MOVE index persistently above 150, that signals major institutions are scrambling to hedge interest rate risk. Third, watch for activation of Federal Reserve emergency lending facilities. The Fed has multiple tools they can deploy quietly before announcing public interventions. The standing repo facility usage by foreign central banks is particularly telling. If foreign repo facility usage suddenly jumps from 10 billion to 50 billion or 100 billion, it means foreign central banks need dollars urgently and are using treasuries as collateral to get them. That is liquidity stress. Fourth, pay attention to spread widening in related markets. When Treasury selling pressure builds, it shows up in other fixed income markets. Investment-grade corporate bonds, municipal bonds, and mortgage-backed securities will see their yields rise relative to Treasuries. If you see the investment-grade corporate spread widen from 100 basis points to 150 or 200 basis points over a few months, that is contagion beginning. Fifth, watch gold prices. Gold typically moves inversely to confidence in the dollar and Treasury market. If gold breaks above $3,000 per ounce and stays there, it is signaling that major players are fleeing dollar assets. BRICS central banks buying gold while selling treasuries creates a powerful feedback loop driving gold higher. Sixth, monitor currency markets, particularly the dollar index and emerging market currencies. If the dollar index, which measures the dollar against a basket of major currencies, breaks below 90 and keeps falling, that is validation of the JPMorgan bearish call. Simultaneously, if BRICS currencies like the yuan, rupee, and real are strengthening against the dollar, it confirms the de-dollarization trade is working. These indicators do not require insider access or complex analytics. You can track them yourself through public data. The key is watching multiple indicators simultaneously. One signal might be noise. 3 or 4 signals flashing red at once. That is a pattern. Now let me give you specific, actionable steps to protect yourself. These are prioritized from most important to least important, and I will explain the reasoning behind each. Strategy 1. Diversify out of long-duration dollar assets immediately. If you hold long-term treasury bonds or bond funds with duration above 7 years, you are sitting on maximum interest rate risk. Reduce exposure now. Move to shorter duration instruments, treasury bills with maturity under 1 year, money market funds, or high-yield savings accounts. Yes, you might sacrifice some yield, but you eliminate the risk of catastrophic principal loss if rates spike. This is your highest priority. Strategy 2. Allocate 5 to 15% of liquid net worth to physical gold. Notice I said physical, gold you can hold, not paper gold ETFs or futures contracts. Buy gold coins or bars from reputable dealers, store them securely, and think of this as insurance, not investment. If the dollar treasury system faces real stress, physical gold will be the only asset universally recognized as valuable. BRICS central banks are doing this for a reason. Strategy 3. Increase cash holdings beyond normal levels. I know this sounds counterintuitive in an inflationary environment, but liquidity is king during financial stress. Keep 3 to 6 months of expenses in readily accessible cash or cash equivalents. During crisis periods, opportunities emerge for those with liquidity to deploy. Those without cash are forced to sell assets at fire sale prices. Be the buyer, not the distressed seller. Strategy 4. Diversify currency exposure internationally. If you can legally do so, consider holding portions of savings in non-dollar currencies. Swiss francs, Norwegian krone, and Singapore dollars are historically stable currencies backed by countries with strong fiscal positions and current account surpluses. You are not betting against America, you are hedging against any single currency system. Even holding 5 to 10% of liquid assets in foreign currency accounts reduces concentrated dollar risk. Strategy 5. Reduce leverage and eliminate variable rate debt. If you have adjustable rate mortgages, home equity lines of credit, or margin debt on investment accounts, either pay them down or refinance to fixed rates. When financial stress hits, lenders tighten credit conditions and variable rates spike. The last thing you want during a crisis is forced deleveraging because your borrowing costs doubled overnight. Strategy 6. Build exposure to real assets with intrinsic value. This means productive real estate, farmland, energy infrastructure, commodities, and businesses that generate real cash flow. Paper assets denominated in dollars become questionable when the dollar and treasury market face structural challenges. Real assets maintain value because they have utility independent of any currency system. Think about what retains value if confidence in financial assets erodes. Strategy 7. Diversify equity holdings internationally and into commodity producers. If you hold stocks, ensure meaningful exposure outside United States markets. Emerging market equities, particularly in commodity-producing countries, can benefit from dollar weakness. Companies that mine gold, produce oil, grow food, or control essential resources maintain value regardless of currency fluctuations. Balance United States stock exposure with international diversification. Strategy 8. Establish relationships with multiple financial institutions. Do not keep all assets with one bank or brokerage. Diversify across institutions, including some that have fortress balance sheets and conservative lending practices. During the 2023 banking crisis, customers with accounts at multiple institutions could move money to safety. Those with everything at one regional bank faced uncertainty and withdrawal limits. Operational diversification matters during financial stress. Here is the critical mindset: you are not trying to perfectly time a crisis or make a fortune from calamity. You are reducing concentrated risk and increasing optionality. If nothing bad happens, these moves cost you very little, maybe some foregone yield or minor transaction fees. If the Treasury dollar system faces serious stress, these moves could be the difference between financial survival and devastation. The cost of preparation is minimal. The cost of being unprepared is enormous. Let me walk you through how this situation is likely to unfold, based on historical patterns and current dynamics. Understanding the phases helps you position appropriately and avoid panic decisions. Phase 1, the slow burn and awakening. We are currently in this phase as of January 2026. BRICS Treasury sales continue but remain gradual enough that private sector buyers absorb the selling. Mainstream media occasionally reports the data but frames it as routine diversification. Treasury yields drift higher but not catastrophically. The dollar weakens gradually against major currencies but not in crisis fashion. Gold rises steadily but not parabolic. This phase is characterized by informed players quietly repositioning while the general public remains oblivious. Think of it like October 1929 before the crash. Market indicators showed stress for months, but most people did not notice until the collapse happened. Phase 1 could last 6 to 18 months. The key event that ends Phase 1 is a trigger. Perhaps a major BRICS nation announces a substantial reduction in treasury holdings, or a derivatives blow-up at a major institution, or a Federal Reserve policy error. Something breaks the slow burn into acute crisis. Phase 2, contagion and forced deleveraging. This is where markets stop being gradual and start moving violently. Treasury yields spike 50 to 100 basis points in days or weeks as selling pressure overwhelms buyers. The dollar drops 5 to 10% against major currencies in a matter of months. Gold surges 20 to 40% as safe haven demand explodes. Derivative margin calls force institutions to liquidate positions across all markets, not just bonds but stocks, commodities, everything. Liquidity evaporates as everyone tries to sell simultaneously. The Federal Reserve responds with emergency measures. They activate lending facilities, potentially restart quantitative easing, and flood the system with liquidity. The FDIC prepares for potential bank failures. Congress debates emergency fiscal measures. Media coverage becomes intense and frightening. This is the phase where fortunes are lost by those unprepared and made by those positioned correctly. Phase 2 could last 3 to 12 months and feels like controlled chaos. Markets swing wildly, policymakers take extraordinary actions, and public confidence in the financial system shakes but does not completely break. Phase 3, Policy Response and Currency Debasement. Eventually, authorities regain control through overwhelming liquidity provision. The Federal Reserve cuts rates back towards zero, restarts massive quantitative easing, and potentially implements yield curve control to cap Treasury yields. The federal government passes fiscal stimulus to cushion economic damage. The dollar stabilizes but at a significantly lower level than before the crisis. Gold settles at a new, much higher plateau. The cost of this stabilization is renewed inflation. When you fight a deflation crisis with unlimited money printing, prices inevitably rise on the other side. Think post-2008, we avoided depression through massive monetary and fiscal intervention, but the price was persistent inflation and asset bubbles that eventually led to our current situation. Phase 3 could last several years as the new equilibrium establishes itself. The world after Phase 3 looks fundamentally different, less dollar-centric, more multipolar, with alternative reserve assets and payment systems gaining legitimacy. This is not prophecy. This is pattern recognition based on how debt crises resolve historically. The timeline is uncertain. Phase 1 could last another year or end next month. But the phases themselves are predictable because policy options are limited and human behavior in financial crises is consistent across centuries. Look, I want to be clear about something. I could be wrong. Maybe BRICS nations reverse course and start buying treasuries again. Maybe the Federal Reserve threads the needle perfectly and manages a soft landing. Maybe private sector demand for United States debt proves unlimited regardless of foreign selling. Maybe derivatives markets remain perfectly stable despite collateral value fluctuations. Maybe I am seeing patterns that do not exist and connecting dots that should not be connected. But here is what I know with certainty: the cost of being prepared for something that does not happen is minimal. You hold some extra cash. You own some gold. You have diversified assets. If the crisis never comes, you are slightly less optimized but perfectly fine. The cost of being unprepared for something that does happen is catastrophic. You lose purchasing power through currency debasement. You face forced selling of depreciated assets. You lack liquidity when opportunities emerge. You watch your financial security evaporate because you assumed the system would work the same forever. $29 billion in Treasury sales in 1 month. $200 billion over 1 year. These are not normal times, and treating them as normal is dangerous. The BRICS nations are not stupid. They employ sophisticated economists, risk managers, and strategists who understand global finance as well as anyone. When they collectively reduce dollar exposure while accumulating gold and building alternative systems, they are reading signals and preparing for outcomes they will not publicly announce. You do not need to become a survivalist or doomsday prepper. You do not need to panic or make extreme decisions. You just need to acknowledge that structural change is underway in the global financial system and position yourself accordingly. The dollar treasury system that dominated for 70 years is facing its first credible challenge, and how that transition unfolds will determine economic outcomes for the next generation. The data is available. The patterns are visible. The defensive strategies are straightforward. What you do with this information is up to you, but I would rather prepare for a crisis that never comes than be unprepared for one that does. Stay informed, stay rational, and stay protected.